Hello, and welcome to an exciting journey into the world of investing and trading in the stock market. My name is Veera Desale, and today I'll be your guide as we explore the fascinating realm of wealth creation and financial opportunities. Throughout this session, we will cover a range of important topics that will help you understand how the stock market works and how you can participate in it. Our agenda includes: what is the stock market? We'll explore the fundamental concepts and functions of the stock market, types of investments such as stocks, bonds, mutual funds, real estate, and commodities. How do companies issue stocks? Learn about the process of initial public offerings, IPOs, and how companies offer shares to the public. How do investors buy and sell stocks? Understand the mechanisms involved in purchasing and selling stocks through brokerage accounts and the role of brokers. Factors affecting stock prices. Gain insights into the factors that influence stock prices, including economic conditions, company performance, and market sentiment. Fundamental analysis versus technical analysis. Explore the two main approaches to analyzing stocks and their respective methodologies. Risks of investing in the stock market. Other types of financial markets. Discover the bond market, foreign exchange market, and commodities market. And finally, find out about resources and strategies to enhance your knowledge and skills in the world of investing. So let's dive in and explore the exciting world of investing in the stock market. The stock market serves as a dynamic platform where publicly traded companies issue stocks to the public. It's like a bustling marketplace where investors can buy and sell these stocks, facilitated through stock exchanges such as the New York Stock Exchange, NYSE, or NASDAQ. Investing in the stock market presents an opportunity to potentially grow your wealth over time. However, it's important to note that success in the stock market requires careful research and analysis. It's not merely a game of chance, but rather a strategic approach to building your financial future. Understanding the basics of the stock market is crucial for making informed investment decisions. By comprehending how it operates, investors can navigate through complexities, seize opportunities, and minimize risks. It provides a foundation for conducting thorough research, evaluating company performance, and analyzing market trends. As illustrated here, there are several types of investments, each carrying its own level of risk and potential reward. Stocks, prominently featured on the slide, represent ownership in a company. Investing in stocks provides an opportunity for high returns, as the value of stocks can appreciate over time. However, it's essential to acknowledge that stocks also come with higher risk due to market fluctuations and the possibility of financial loss. Thorough research and analysis of individual companies are necessary when investing in stocks. Moving on, bonds are also another type of investment. They involve investors lending money to a company or government in exchange for regular interest payments. Bonds are considered relatively less risky compared to stocks, as they offer fixed income and are typically associated with more predictable returns. Investors seeking stable income streams often include bonds in their portfolios. Additionally, mutual funds and exchange-traded funds, or ETFs, provide avenues for diversification. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. This diversification helps spread risk and potentially enhance returns. Understanding these various types of investments allows investors to tailor their portfolios based on their financial goals, risk tolerance, and time horizons. This slide explains how companies make their stocks available to the public. Let's break down the process in a way that's easy to understand. When a company decides to offer its stocks to the public, it usually seeks assistance of an investment bank. The investment bank helps the company with important steps along the way. First, the investment bank helps the company figure out the right price for its stocks by analyzing various factors, such as the company's financial performance, industry trends, and market conditions. The goal is to determine a fair price that reflects the value of the company and attracts potential investors. Once the price is set, the investment bank takes on the responsibility of underwriting the initial public offering, or IPO. This means that the investment bank buys the stocks directly from the company and then sells them to the public. During the IPO, the investment bank markets the stocks to potential investors, including big institutions, funds, and individual buyers. They use their knowledge and connections to generate interest and facilitate the sale of the company's stocks to the public. The IPO is an important milestone for the company. It means that the company is transitioning from being privately owned to becoming a publicly traded company. This allows people like you and me to buy and sell their stocks on the stock market. By going public and issuing stocks, the company can raise funds to support its growth plans, pay off debts, and invest in new projects. Understanding how companies issue stocks gives us insight into how businesses raise their money and offer opportunities for people to invest in their success. This slide explains how investors like you can participate in buying and selling stocks. Let's break down the process step by step. First, investors need a brokerage account, which is provided by financial institutions. Think of it as a special account that allows you to access the stock market and trade stocks. When you want to buy a stock, you place an order with your broker. This is like telling your broker which stock you want to buy and how many shares you want to purchase. The broker then takes your order and sends it to a stock exchange. Stock exchanges are like big marketplaces where stocks are traded. There, your order is matched with someone who's willing to sell the shares you want to buy at the price you're willing to pay. Once the order is executed, congratulations! You become a shareholder of the company. This means that you own a part of the company and can potentially benefit if the stock price goes up or the company pays dividends to its shareholders. Now, what if you want to sell your stock? The process is similar. You place an order with your broker, telling them which stock and how many shares you want to sell. The broker then finds a buyer in the stock exchange who's willing to purchase the shares you're selling at the price you want. Once the transaction is complete, you are no longer a shareholder of that company. Remember, the stock market works based on the forces of supply and demand. The price of stocks can go up and down depending on how many people want to buy or sell them. By participating in buying and selling stocks, you have the opportunity to invest in companies and potentially make money. It's important to do your research, understand the risks involved, and make informed decisions. The price of a stock is influenced by several factors. Let's explore some of the key ones. First, the price of a stock is determined by the forces of supply and demand. If many investors want to buy a stock, the price tends to go up. If many investors want to sell, the price tends to go down. Other factors that affect stock prices include company earnings reports. Positive earnings growth can boost investor confidence and drive stock prices up, while disappointing earnings can cause the stock price to decline. News events. News related to the company or its industry can impact stock prices. Positive news can drive prices higher, while negative news can lead to a decrease. Economic indicators. Factors like interest rates, inflation, and GDP growth can influence stock prices. A strong economy generally supports higher stock prices, while economic challenges can create downward pressure. Geopolitical events. Global events such as political instability or trade disputes can create uncertainty and affect investor confidence, impacting stock prices. Remember, stock prices are influenced by a combination of these factors, and predicting them can be challenging. This slide discusses the potential risks associated with investing in the stock market. Let's explore them. Investing in the stock market comes with certain risks that every investor should be aware of. Here are some key points to consider. Volatility and unpredictability. Stock prices can be volatile, meaning they go up and down rapidly. This volatility makes it challenging to predict short-term price movements, and investors may experience losses if they buy a stock that declines in value. Market fluctuations. The stock market can be influenced by various factors, including economic conditions, company performance, and investor sentiment. These factors can cause market fluctuations that impact stock prices, potentially leading to losses for investors. Lack of diversification. Investing in a single stock or small number of stocks can increase the risk of losses. If that particular company or industry performs poorly, your investment could suffer. Diversification, which means spreading investments across different stocks or asset classes, can help mitigate this risk. Economic downturns. During economic downturns or recessions, stock prices tend to decline. This can be a challenging time for investors as the value of their investments may decrease. Despite these risks, it's important to note that historically, the stock market has provided higher returns than other investments over the long term. This is why many investors choose to include stocks in their investment portfolios. To navigate these risks, it's crucial to approach investing with a long-term perspective, conduct thorough research, and diversify your investments. It's also wise to seek guidance from financial investors or educators to make informed decisions. This slide presents a comparison between fundamental analysis and technical analysis, two popular methods used by investors to evaluate stocks. Let's explore them. Fundamental analysis involves evaluating a company's financial health, future prospects, and other factors to determine its value. Key points to consider are analyzing financial statements, management team and industry trends, identifying whether the company is undervalued or overvalued, focusing on companies with strong financials, competitive advantage, and solid management. It helps identify long-term investment opportunities, and investors who use fundamental analysis assess a company's intrinsic value and make investment decisions based on its growth potential and profitability. On the other hand, technical analysis involves evaluating stocks based on patterns and trends in their price and volume data. Key points to consider are analyzing charts, graphs, and market trends, identifying potential buying and selling opportunities, focusing on short term trading decisions, utilizing indicators like support and resistance levels, moving averages, and other patterns. And investors who use technical analysis rely on market data and patterns to make short term trading decisions. Both fundamental analysis and technical analysis have their advantages and are used by investors with different investment goals and time horizons. Fundamental analysis is suitable for those seeking long term investments, while technical analysis is more useful for short term traders. It's important to note that these methods are not mutually exclusive, and some investors may use a combination of both to make informed investment decisions. This slide highlights that the stock market is just one of several financial markets. Let's explore some of the other types. Bond market. In addition to the stock market, there's the bond market. Here, companies and governments issue debt securities known as bonds to raise funds. Investors can buy these bonds and earn interest over a specified period until the bond matures. Foreign exchange market. The foreign exchange market, also known as a forex market, is where currencies are bought and sold. This market facilitates the exchange of one currency for another, enabling international trade and investment. Other investments. Besides stocks and bonds, there are other types of investments that have their unique markets. For example, real estate market. The real estate market involves buying, selling, and renting properties. It includes residential, commercial, and industrial properties. Commodities market. The commodities market deals with trading commodities such as gold, oil, wheat, and other raw materials. Investors can buy and sell these commodities through exchanges. Each of these financial markets serves a specific purpose and offers different investment opportunities. It's important for investors to understand the characteristics and dynamics of these markets before considering investments. This slide aims to clarify the distinction between markets, exchanges, and indexes. Let's explore each of them. Markets. In the context of finance, a market refers to a broad term used to describe a platform or system where buyers and sellers come together to trade financial assets, such as stocks, bonds, currencies, or commodities. It represents the overall environment where transactions occur. Exchanges. Exchanges are specific organizations or platforms within a market where financial assets are bought and sold. These exchanges provide the infrastructure, rules, and regulations necessary for trading. Examples include the New York Stock Exchange or NYSE, NASDAQ, London Stock Exchange, and Tokyo Stock Exchange. They act as intermediaries, facilitating the buying and selling of financial instruments. Indexes. An index is a tool used to measure the performance of a particular group of stocks or other financial assets. It represents a statistical indicator that tracks the value of a selected set of investments. Indexes provide a snapshot of the overall market or a specific sector, allowing investors to assess the performance of their investments against the index. Commonly known indexes include the S&P 500, Dow Jones Industrial Average or DJIA, and Nasdaq Composite. If you would like to learn more about investing, then here are some helpful tips. Explore books, discover online resources, attend financial institution classes, conduct research, and consider your goals and risk tolerance. In conclusion, investing in the stock market offers the potential for long-term wealth growth, but it requires careful research and analysis. Here are some important reminders. Conduct research, diversify your portfolio, have a long-term strategy, and avoid short-term market fluctuations. This concludes the presentation about the stock market and investing. Thank you for your time and attention. I hope you found it informative and inspiring. Best of luck on your future investment endeavors.